Hello and welcome to another episode of Fractional Impact. Today we're speaking to John Strangway about why so many growth-minded businesses can stall out, how to interpret financial data into real business strategy, and how to manage cash flow through good and bad economic times. John, would you like to introduce yourself?
Yep, my name's John Strangway. As you mentioned, I'm currently working as a fractional CFO and helping businesses to kind of grow, to scale, and sometimes just to solve problems.
Awesome. And we're joined today by Gianna Magliari. If you'd like to introduce yourself, Gianna.
Thanks, Stuart. Yep. Hi, everyone. I'm Gianna Magliari. I'm part of the team at fractionalclients.com, and I'm super excited to be getting into this today with John.
Fantastic. So my first question, John, just so that the listeners can get a deeper sense of who you are and what you've done, walk us through your experience and what you've been doing over the last few years.
Well, I'm a chartered accountant. Started out in the public accounting world back, in 1990. So it's been a few years. I grew a firm there, started out on my own and grew a firm to about 12 employees and a decent chunk of billings, and did that for about 15 years, by which time I was, starting to look for something different and thinking of different options and things to do. And at the time I had a friend who had started this small mortgage investment corporation. So he was taking in money from investors and loaning it out to home builders. So at the time, the regulators were starting to look into that industry more than they had previously and needed a little bit of formalization. So I put my practice up for sale and joined up in the mortgage company, kind of jumping into that with both feet, and did that for about 10 more years, and left that a couple of years ago and have been kind of branched out into this fractional CFO role, just looking for mainly interesting things to do and interesting people to work with.
Sweet. When did you get into the mortgage game? Because whenever someone talks about, mortgages and that sort of investment type of business, I always think about the 2008 crash, and I don't know if you've ever watched The Big Short, which is a really good movie about that. Yeah,
I have, yes.
When did you get into that whole mortgage business?
So I got involved in 2010 is when I joined up full time. Prior to that, I had been doing some work and in my accounting firm. That's actually how I knew this fellow. I had been doing some work for him already and a bit of consulting back and forth. So yeah, we was kind of involved through that time period. And yeah, that was kind of a scary time when the whole market melts down, and it can certainly take some adjustment. But the banks, the banks were kind of highly leveraged at that point. And this particular business that I became involved with, we had no debt. Everything that we loaned out at that time was investors' money. So with no debt, you don't have that problem of the bank coming in and telling you how to run your business. And we were able to foreclose on a bunch of properties where we needed to, and build out a few homes that were half finished at the time, and rode through it reasonably well. So obviously it was a time of lower income and lower earnings and some struggles, but came through it all right. So
what made you want to jump from the from having your own practice into going full-time into the mortgage related business?
Well, primarily just I was getting bored. You do the same thing year after year, and after 15 years, you're starting to think maybe there's something else to look at out there. The public accounting world, you spend a lot of time looking backwards. You're always helping people to prepare financial statements that show what they did last year. And often they're, by the time you're looking at it, it's 6 months beyond their year end, and not uncommonly people are late, and maybe it's even 10 months after their year end. So by the time you're looking at it, it's too late to make any changes. And I really was interested in instead of looking at what other people had done in the past, I wanted to be considering what I was going to be doing in the future.
With your experience growing your own firm to 12 employees, which is a huge accomplishment, how did that sort of founder mindset and your experience actually running a company, how does that play a role now with your fractional CFO type of work?
Well, I think largely it's because it's a case of I've been there. In a lot of cases, a fractional CFO or a CFO in general came from public accounting, but they didn't own the firm and they didn't run it. They were an employee there. Then they move into the CFO space and they're working and advising. But I think when you're advising founders, if you haven't actually been in the trenches and started a business and had the frustrations of hiring and how you're going to get, not your 100th client, but your second client and your third client. And that kind of experience, I think, is sort of invaluable, seeing what the problems are, the issues, dealing with, from leasing your office space to where you buy the Kleenex, and those kinds of things. That sort of experience, I just don't think you get if you haven't run your own business. And if you haven't started it right from scratch, I think it's hard to relate to people who are trying to do that.
Yeah, totally.
So.
When you were at the mortgage company, if I'm not mistaken, you helped take them public. What was your role in that? What did that look like, actually taking them from being sort of privately owned to public?
Yeah, well, essentially I led the whole process there, and that is a kind of a complicated thing. And I think it's difficult for entrepreneurs because you're used to running your business the way you want to, and if your mood changes, you're going to jump in a new direction, or if you see some opportunity, you can reach out and grab it. When you go public, you're kind of constrained by the public markets, and you have to be more predictable and you have to be more routine. So the first thing you do when you go public is that you have to write a prospectus. And in that prospectus, which is supposed to lay out all of the aspects of the business, all of the risk factors. So you have to spend a lot of time systematizing and thinking about how you're functioning and operating. And then you have to write it all down. And then you're going to put it into a public document that you're going to put out to investors. People are going to invest based on that document. And so then going forward, you're going to have to follow it, and you're constrained by that. So, on the upside, you gain a bunch of access to public markets. You maybe get a bunch of investors. There certainly can be a growth, a growth direction there that can be very beneficial. But as a downside, you get stuck because you're kind of locked into a business plan. Not forever. You can make changes as you go, but in the early stage, when you say to investors, we were in the mortgage business. When you say, we're going to take your money, we're going to lend it to this type of borrower, we're going to have these kinds of restrictions on ourselves as to what we do and how we lend and how we evaluate loans. You can't just change it up after that. You kind of are locked into a certain business plan. So you have to spend a lot of time systematizing what you've done and making sure it can be communicated, making sure that people are going to like what you have to say, and then you're kind of stuck following it. So a lot of what I was doing at that time was, doing that kind of writing of how our processes worked. And I mean, to be honest, in a lot of ways, it's a good exercise for a business to do, but the level of depth, is obviously higher in writing a prospectus than anything anybody would really enjoy doing for their own business.
Yeah. Because for me, I've had this business for about 4 years now, and it's always been just myself as the owner, which makes for a lot less hassle, let's say, because my brother, he co-owns a company. He's not the sole shareholder, and it sounds like a lot more faff, because you have to have, board meetings and then minutes, and other people need to help make decisions. And so I can't imagine what it would be like going public. It must be a whole nother level of complexity. Do you think that's a good goal for the types of founders and companies you're working with at the moment? Do a lot of them have that goal of having an IPO or going public, or do you think they're better off, selling before that stage? What would you advise?
Yeah, I think it can really, really depend a lot. And the people that I'm working with right now, I don't have anyone looking at that at the moment. It is funny because the public markets too are very driven by trends and by what the public wants at the time. So, if you are going to try to bring, essentially businesses that are out of fashion to the public market, you will struggle to sell the shares and you will struggle to get your share price up. But if you're an AI firm right now, you probably could sell, all day long, whether you've got a really solid business plan or not. And because the markets are kind of funny and quirky that way, and really are about the flavor of the month. So, if you have a business and you're looking for more capital, or you're looking for that exit, and so you're thinking of going public, you have to first know whether you have a business that suits the public markets, one that can be described easily, that people can understand, that they can follow along. Also, one that needs a lot of capital, because I've heard some people saying, I want to go public as an exit strategy, but the business itself is maybe not capital intensive, which is what the public markets are intended for, is raising capital. And then I think you really have to consider whether you have a business that is, is in vogue at the moment. Do you have a business that the market is going to respond to? You could have the best, most solid, profitable business in the world. If it's not what the markets are looking for at that time, you won't have a successful capital raise.
That's interesting. So do you think timing with capital raise, not necessarily the timing of the stage that your business is at, but more the stage the market is at, is critical?
Absolutely. Yeah. I think it's a real combination of those two factors. You have to be ready and needing it, and the market has to be cooperating at the time. And I think that's why a lot of small startups fail on their launch, right? And if you don't have both of those factors working right at the same time, it's not going to work. And at a bare minimum, you're probably looking at $300,000-$400,000 to write a prospectus and do the legal work to get going, and that's for a relatively small business. But you can spend a lot of money, and if it doesn't work, it's a pretty frustrating process.
Yeah. Wow. In terms of your role now as a fractional CFO for different companies, how do you sort of help them move beyond their finances just being numbers on a page to actually using that data as a driver of strategy?
Yeah, well, I would have to say I'm working mainly with smaller, mid-sized kind of firms, and I think most of them have in common that their data is behind the times. They don't, the average entrepreneurial founder with a vision is not focused on making sure that they're keeping their accounting current and their bookkeeping up to date. And if it's already 6 or 8 months, out, even if you look at that data and try to analyze it with these, are rapidly changing and hopefully scaling, but even just in a small business that has changes all the time, it's hard to get a good sense of where you've been and where you're going if you don't have up-to-date data. So the first thing I would want to do is make sure that they see the importance of that, of having data to even look at. So once you get those kinds of basics in place and you kind of get up to speed, then I think it's kind of a two-part thing. You want to, on the one hand, step back and look at the bigger picture of how things have gone and sort of bigger strategy issues. But I think too, it's a matter of getting down into the weeds of the data and really looking into accounts and balances and what are they spending money on? Because in my experience, business often is make or break at the margins, and you need to really be paying paying attention to a lot of the details, as well as paying attention to the big picture, longer term kind of a strategy. So, sometimes founders have that big picture idea and they're chasing the brass ring, but the details have fallen by the wayside, and so they're not profitable regardless. And sometimes, and I feel like I see this quite a bit too. You get business owners that get bogged down in the details, and they can get hung up doing busy work because they don't know what that next, larger strategy step is. So sometimes you need to come in and say to people, stop, focusing so much on the details and start looking at the bigger picture. And sometimes you need to say to people, pull your head out of the cloud a little bit. Let's build this structure a little stronger and a little better and get this foundation built so that you've got something to step up onto.
Are you able to share a particular example of when a change in data interpretation or perception led to a bigger strategic shift?
Do I have a good example of that? I don't know. I that you put me on the spot with that one.
I did.
For a specific example. Really, it's in our mortgage business, kind of looking at spending a lot of time looking at what are the most profitable loans and which ones aren't. And we really realized that multifamily was not working well for us, and that we had our best, most profitable loans that we had kind of the least foreclosures on and the least issues with were the smaller builders building single family homes, and one or two at a time. And once you could kind of focus in on that and see where the really profitable part of the business was, then you're able to sort of zoom in on that and start getting rid of the extra stuff.
What type of company is it you're looking to work with at the moment? What are your main sort of industries or stage?
My experience is in the investment and mortgage business. So I'm interested in that and think I have a lot to contribute there. We were doing construction lending. So I've also got we had a small construction company that we used when we did have to take a project back and finish it out. So I do have a fair bit of experience in the construction management side, and that's been a fair bit of the jobs that I've been doing lately have been on the construction side. So I've got quite a bit of experience there as well. But I find in business in general, an awful lot of it is transferable across industries, and there's a lot of basics and a lot of people that need information and data examined, and I'm fairly open to different and new things, and in fact I really enjoy learning and looking at new things. So
one of the cool things that you've done is helped companies expand into new markets. So I know that British Columbia and Nova Scotia are places that you've moved into for an Alberta-based company. What makes for a smart market expansion strategy?
I think first and foremost, the product that you're selling has to work in the other market. That's the biggest thing. It's the adage about trying to sell refrigerators in the Arctic, right? It's probably not a good idea. So figure out if what you have is transferable, and then of course, another in the mortgage business, one of the big issues is the regulatory environments, because every different province and every different country and region is going to have different rules and different sets of rules and different requirements and registration requirements. So that can always be a challenge to overcome as well. So if you can get through that, if it makes sense to expand into that market and you can get through the regulatory side, and then it can be beneficial. There's what else is sort of a good strategy? I would really have to say, do your market research, make sure that the new market wants you there, see what the competition is like, because of course they have a bit of a leg up on you already, having already been there and working in that environment. And then, it's all a matter of details.
How do you decide whether a business is really ready for expansion yet, or if it's best to just...
Actually, sorry, I want to just step back one more thing, because another thing is, it just sort of occurred to me. Another problem with expansion sometimes, and this is just an example, is that in the States, they will always want to expand into Canada. But again, this is a regulation. Canada is a bilingual country, and in Canada, we require packaging to have both French and English on all of the packages. So that's kind of it seems like a minor thing, but if you're making breakfast cereal and suddenly you have to change all your boxes in everything that everything you're sending up north, it can actually be a big headache. And that's where, we have been hearing lately with all these tariff issues, and we've got, Donald Trump complaining about Canada being a closed market. That's one of the things he's complaining about, is our requirement to have 2 languages on packaging. So there can be issues like that too that you wouldn't even really anticipate.
Is that across all of Canada, or is that just in Quebec or any other French places?
Yeah, no, it's across all of Canada, because it has to do with Quebec and their original, when Canada was originally formed, it was formed by Quebec and the rest of Canada coming together and joining. And so they were guaranteed at the time that Canada would be a bilingual country and would have 2 official languages. So despite that most people speak one or the other and not both, that's a national policy, and you have national rules regarding that.
Wow, because there must not be that many people in Toronto or Vancouver that speak French. It must not be very common.
No, not common at all. But it's So and like I said, I mean, I don't think he's completely wrong being frustrated that is a. But that's one of these the non-tariff barriers that he refers to as being problematic with Canada, is our requirement to have French on the packages. And sometimes things don't translate that well. If you have a brand name that works really well in one language, it just might not work in another. So suddenly you're also gearing up your advertising department to figure out what to change the name to, and your the brand that you spend all this time and money building maybe just doesn't translate well.
So if I had a British direct to consumer company, I was selling drinks or something, and I was thinking, okay, I'm going to expand. Maybe I'm going to go into mainland Europe, maybe the US, maybe Australia, maybe Canada. Does that make Canada less of a viable option for me?
To be honest, this isn't my area of expertise. I think direct to consumer, you're okay. It's more if you were going to bring it in and you want it stocked on the shelves in the local grocery store, it becomes an issue.
Interesting.
Yeah. But I mean, again, I'm sure every country around the world has their own, issues. And I mean, that one might be unique to Canada, but, and that's where an expansion, plan could easily fall down if you haven't looked and considered all those things. So it's when you go across jurisdictions, you have to really think, have you exhausted your expansion where you are? Does it make sense to start, going outside or not? I mean, really what you're looking for is markets where the benefit is going to outweigh the costs. And if you're just trying to push yourself into a market that's already well served and your product is represented by 3 or 4 brands there already, it might not be worth the problems of making the adjustments.
On the flip side, I guess situations like this, sometimes founders can see compliance and similar issues as a blocker or as sort of red tape. How do you convince them that it's actually a growth enabler rather than a blocker?
Yeah, well, because the regulatory burden falls equally on all businesses, and if you can handle it well, it actually can be a competitive advantage. If your competitors are falling down on the compliance side and the regulatory side and aren't able to keep up with it, and you can get your team geared up and going to do that, it actually can be an advantage. Again, you talk a lot about the regulatory burden on a public company, and that's again something I think that a founder would kind of rail against to some extent. They're not going to like that regulatory burden, but it actually can be in some ways, in that circumstance, it can be kind of a get out of jail free card, because if you've got a good compliance program and you can point to how well organized that is and how well you're following regulations, and it can be a good defense that you've done your due diligence if someone is making complaints. If you write into your prospectus, this is what we expect to achieve or what we plan to achieve, but there's a warning in there that says, but it could be 0. We could do something differently. Then you can't have someone come back later and say that that they weren't warned. So often the regulatory and compliance issues are about warning the marketplace and warning the regulators about things that can go wrong. And in a lot of ways, I mean, to be honest, people don't read those warnings very clearly, but if they've been put there, then you can point to them if you need to, if something's gone sideways. And I do think that's a lot of what I'm looking to help businesses with too, is obviously, look for ways to exploit and build on the upsides. But I like to think that I'm spending a fair bit of time helping them protect themselves on the downsides too. And that's where the regulatory rules and making sure you've got a good compliance program can really help with that feature. So.
Yeah, because that was something I was going to ask actually, is when you come into a company and maybe they're growing quite quickly or they're very ambitious, but they're not that big right now, which obviously fits a fractional CFO quite well. If when they grow, they're going to probably face some regulatory or compliance issues or obstacles. Is that something that you can manage as a fractional CFO, or do you recommend that they bring in like a chief compliance officer, which I've actually seen some on LinkedIn? What's the best way to go about that?
Yeah, well, that's exactly right. And I guess every industry is a little different. Some are very compliance intense. So we were in the investment business, and as soon as you're selling to investors, particularly in the public sphere, you're actually required to have a chief compliance officer. So someone to make sure, and I did serve that function, but it's one of those things that you need to be able to keep up with changing regulations all the time. So I would probably be a little reluctant to take that on for a client now, but I'm certainly would be able to help steer them to what they need, whether they in fact need one or not. So there are. I certainly can take on some of those roles, and some of that compliance is not that technical. But once you get into some of those environments where it really is deeply technical, then I would be helping them outsource that role to somebody else. But yeah.
In your time with the mortgage company, you managed that mortgage portfolio through strong and weak economic times. What are the biggest differences, sort of an approach between those two economic climates?
Yeah. Well, in sort of poor economic climates, you've got property values probably declining, but you've also got governments trying to prop the economy up. So you've generally also got interest rates declining. So if you can, so we were, when you're lending on a mortgage, you're looking at the value of the property and you're trying to leave yourself a decent margin for error, and you're lending, somewhat less than the value. I mean, we sort of had a target of less than 75% loan to value. Some banks 80, so there's a bit of a range, but as values slide, you need to be dropping what you're lending comparatively. So that can be a bit of an issue. But on the other hand, if interest rates have come down, sometimes it's a little easier to make those quality loans because you're offering lower rates to the borrowers. And the other thing you can do sometimes is that if rates are down, you can go out and borrow some money in order to leverage it up your investors' capital and improve the returns to your investors. So, in a down market, there are still opportunities. People still with, well-qualified people that have decent jobs are still looking to buy properties and still looking to take mortgages. And you need to find the opportunity, whether it's through more leverage or, maybe if in a lower interest environment, your investors expect lower returns, you can, there's some flexibility there. In a growth market, you have to be a little bit careful because typically interest rates are probably rising. Property values are also rising. So in a default, you're better covered. So there's that aspect of it. And you're probably in a better position to take a little bit more risk, and perhaps you'd be making some higher rate loans to what before might have been considered a higher risk client, or a client you might not have wanted to loan to, if the market values of their property are growing and increasing, and you can see that your coverage is fine and is improving over time. You might be able to make some riskier loans that you otherwise wouldn't make, and again, make better returns from your investors. So, it's really just a matter of trying to find the opportunities where they lie. Right now, in our market here in Vancouver, there's a bit of a downturn in condominium construction. Everything's sort of, that market's been kind of overbuilt, and a lot of the developers are kind of pulling back on that, which is causing a sort of a trickle down, and a lot of smaller trades and sub trades are starting to struggle. So right now there's an opportunity to buy heavy construction equipment. So I've got one client that's sitting on some cash, and I'm working with them to look at buying some cranes, which they used to rent, the construction cranes, and it's not unusual to be paying $25,000 a month on a construction site to rent a crane like that. Right now, a crane that might have been $500,000, you can probably buy for $200,000 at the moment. And if you can do that, once you get your next job and things have turned around a little bit more, that's a big savings in your construction projects. There's always opportunities even in downtimes.
If we were heading into a downturn tomorrow, what would be the first few things that you would advise a founder to do?
Well, probably protect your cash. Look at what your outlays are. Your capital outlays, where you can kind of hoard money to see it through the downtime. And if you're the type of business that has enough cash that you're sitting on it, there's buying opportunities at the bottom of the market. If it's a bit of a struggle, the biggest thing is to try and get ahead of it. And it's hard. Nobody can foresee the future with total clarity. But if you're heading into a downtime and you've realized it's coming, then it's time to sort of start pulling in your horns a bit and figuring out where you can keep your cash and where you shed responsibilities. And the sooner you do that, and the faster you act, and the more you get ahead of the curve, the better off you're going to be.
With the mortgage stuff, obviously, you guys were giving out mortgages, and you have your investors. I'm a total layman in the sort of mortgage world, but I'm assuming the business model is the investors give you money, you loan that money out with an interest rate, and then with that interest rate, you can pay off the investors and profit for yourself. Is that correct?
That's exactly correct.
So when it's a down, when the market is doing badly, you were saying that the interest rates are lower.
Mm-hmm.
Is the only reason that investors don't pull their money out, is that because it's a down market, other investment vehicles are also lower in performance, and that's why they're happier with the smaller interest rate? Or do they not get a certain percentage of what you're loaning out? Like, how does that work?
Yeah, well, so we were loaning it out, and generally, there'd be a fairly decent spread. So our investors were expecting about 8%. That's what we, were telling them that they could reasonably expect. But and then if the company did better, then they got paid more. But typically, we wouldn't. It would have been very unusual for us, even in a down market, to lower our rates low enough that we couldn't have paid that 8% to our investors. But yeah, essentially, we're trying to loan it out at a higher rate than we're paying, and the profits then get paid. We were paying dividends, so you calculate it based on the net profit of the business. So if the net profit slid far enough, you wouldn't be able to pay those returns. But again, that's where, so a lot of the smaller private mortgage companies are structured in a way that people can pull their money out. So that's another difference in the public market. If people want out, they don't phone us and say, we want we want to redeem our shares and get our money back. They go to the public market and sell them, in the market. So if we are unable to pay the dividends that we had been expecting to, and unable to pay the dividends that they had grown to expect, then their option is to go to the market and sell it. But likely at that point, the share value has dropped a little bit too, so they can decide whether they'd rather hang on and keep it and wait till it's doing what it's supposed to again, and accept that it's a bit of a market downturn. In our case, we never had that issue. We were always able to pay what we were expecting to pay. So, but ultimately that would have been the remedy, is to sell the shares in the market, and they might be up at any given time, and they might be down. So,
obviously, shorting the property market isn't very typical. Obviously, there was those 2 or 3 guys in The Big Short that did it in the 2008 crash. But when there's I'm not sure if it would be a down market or a good market that would cause this, but was there ever a sort of market climate where people were shorting the mortgage companies themselves, but not the housing market, if that makes sense?
Yeah. Not that I've seen or am aware of. That the Big Short and that particular circumstance was kind of unique, and it was kind of a problem of people just really not understanding the risk of all these mortgages that were, all of those subprime mortgages they call it, but basically, mortgages that were just too much loaned against too little equity, and when they all, and that's the funny thing. People say, you look at mortgages over the long term, and you say, well, 1 or 2% go bad, but the way it really is that none go bad for 50 years, and then in a 6-month period, 50% of them. I mean, I don't know the numbers, but it's kind of like the black swans. When they come in, they all land at once, and you might have no losses for ages, and then they all hit at the same time. And that's kind of, it was that perfect storm in that, example in 2008, where people were counting on long-term statistics without really thinking of the fact that mortgage losses are not, they don't quite work like that. They go nothing, 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 and then they all come at once when they come.
Do you find that the companies that survive those types of events in any market, could be the housing market, could be other markets, do you think it's typically the companies that have the strongest cash flow and can therefore basically wait out their competition?
Oh, absolutely. And if you got a bunch of cash in the bank and your business turns cash out, then you're well positioned to ride through those things. But it's again, everything in business is a balancing act, because if you hoard all your cash and sit on it and you don't have it fully invested, or you don't take advantage of opportunities when they arise, you're safer when the market turns down on you, but at the same time you've foregone growth and opportunity that you might have otherwise had. So you have to try and predict what the worst case scenarios are and be prepared for them, but operate for what's happening today. It's and that comes down to an individual decision of every business owner. How conservative do I want to be? How much do I want to push growth? There's an awful lot of people that have gone under because they pushed growth and then had a downturn, arrive too quickly when they weren't expecting it and weren't prepared for it. But on the other hand, there's probably that it wouldn't be advertised, but there's probably a whole ton of businesses that are sitting on cash and not growing in the way they could because the owners are too conservative and aren't willing to spend. So that's something that I, as a fractional CFO, can't say to someone, this is the correct cutoff, like get your money working or hang on to your money. But I can help the owner understand what those kinds of trade-offs look like. And one of the things I've been doing a fair bit of lately for one client in particular is modeling, what does this look like if there's a 10% reduction in business? What would it look like if there was a 10% increase? How big are the swings there? And you can kind of do sensitivity analysis of different scenarios, so you can understand how exposed the business is.
Yeah, it's a really interesting one for me, because you had something similar in Russia when the wall came down in the early 90s, where because there was such a shake-up to to how things worked from an economic perspective.
Yeah.
A more limited amount of quite a small number of companies or people were able to buy up a lot of the sort of businesses and assets for such a low price because of sort of the mess that it was. And then, of course, they turned in to be the sort of oligarchs that benefited as the market came back because they owned so much of it. When you're working with companies that are in such a strange economic climate for their market, how do you watch out, or how do you look at what the competitors are planning for? Because I know that a lot of the time what the competitors are planning for can sort of guide your strategy. Because if all your competitors are betting on one thing, then it can sort of create an opportunity somewhere else. Or is that not really possible and you just sort of have to guess?
Yeah, I think it's difficult because you can have a sense of what your competitors are doing, but I don't think you can really see inside their businesses or their heads enough to know. And sometimes you see things that they've done. So in hindsight, you can see what they were thinking, but it's probably too late to act on it. And then of course, the other funny thing about that is that markets, well, like the stock market, it swings so much with sentiment. So when people think that uranium is the next big thing and every uranium stock goes through the roof, and then when it's not anymore, they all fall. And when investors think the .com companies in the 2000s were the hottest thing, and they go up until the bubble bursts. And so your competitors, everyone's, the reason there's a bubble in real estate or in .com stocks or in AI is because everybody's jumping into it at the same time. So if you had a crystal ball and you knew that bubble was going to burst, you could be prepared for it. But looking at what your competitors are doing, that's why the market's doing what it's doing. That's why the bubble is growing, is because everybody's going the same direction. You do the best you can, and you hope you don't get caught when it bursts. But a lot of people are going to be, no matter what.
Yeah. So what I'm wondering actually is, you were saying about how at the mortgage company, it was typically an 8% yearly return. Was there a sort of minimum buy-in that your investors had to have, like $100K, $500K, $1 million, to be able to sort of access that investment, or was it basically open to any level of investor?
So that's another one of the big differences between the public and the private market. So when you're selling a smaller private market investment, in Canada, the rules are probably different elsewhere, but we had some limits as to who you could sell to, and they had to be essentially higher net worth individuals, and or there were some other rules that said you could sell if they had a minimum $100,000 investment. So you had some restrictions on who you could sell to. So the product really could only be marketed to investors with a higher level of sophistication and higher level of resources. Once you're in the public market, that's essentially the difference, is that in the public market, you've issued a prospectus which the regulators believe accurately describes all of the risks of the business. So because you've done that level of disclosure, then in the public markets, they allow anyone who wants to buy the shares. So at that point, you could go into the stock market and buy one single share for $10, is about what we were trading at and what we issued at. So in fact, you could get invested with $10. And that is one of the major differences. So that's where you do have access to that retail small scale investor in the public market that you don't in the private, because of the regulatory requirements that keep those small people out.
Yeah, that all makes total sense to me, where the bigger the company, not necessarily the bigger the company, but the more of a prospectus there is and things like that is then needed to basically protect the small time investor. It sounds like this is all based on protecting.
That's what the regulators are. Yeah.
How does, over the last few years, with things like cryptocurrencies and NFTs were pretty big a few years ago, that must have totally shaken up the game, where now you have these smaller time investments with tons of risk and little regulation that are open to public markets, because that goes totally against the whole philosophy of protection in those more traditional investments.
Yeah. Well, and that's where the regulators are really scrambling to deal with cryptocurrencies. They don't know which way to jump. And, and I think they're right. I don't think I know what the answer is to cryptocurrency. It's obviously it's gone through the roof. When I look at it, I kind of think it sort of has the aspects of a bubble to it. Like it's something that, the only reason that it goes up is because one person is willing to buy it from someone else for more than the first guy paid. And it's kind of a strange, phenomena. It's not backed by anything, but I mean, on the other hand, in hindsight, I wish I had put $100,000 back, in 10 years ago. So it's hard to know. And I think the regulators have the exact same problem. How do you fit this into the boxes? How do you, it's kind of uncontrollable in a lot of ways. And it's outside the current regulatory environment in a lot of ways.
The thing is, though, a lot of the arguments that can be made there to do with, it's not backed by anything. I mean, how many currencies in the world now are backed by anything?
Yeah.
Basically every currency's been taken off of the gold standard and is backed by nothing. So I guess it's more a question of not backing, but how common it is. We don't talk about the US dollar being a bubble because it's not backed by something, because of how common it is. So I would think if something like Bitcoin can become more common, then those arguments of, oh, well, it's not backed by anything, etc., kind of lose some of their power.
Well, except that a currency is kind of backed by the assets of the nation. They're backed by the assets that the federal government owns. I mean, could you really foreclose and take that away? Probably not. But there is something more tangible about a country. The problem with Bitcoin is, it's valued. I don't even know what it's valued at today, but if I decide tomorrow that it's not worth that much, and all the other investors decide tomorrow that it's not worth that much, it'll fall just as fast as it rose. And I mean, currencies don't tend to swing that hard and that fast. They can, but they do have a little bit more backing in terms of, well, like I say, the assets of the country and just the ability of the country to earn its way back out of it. I mean, even if something is backed by, the shares of a company are backed by that corporation and its ability to earn its way back out of a hole if it falls into one. And the same thing with the country. It has some ability to earn its way back out of the hole it finds itself in. But the cryptocurrencies, there's no productive assets there. There's nothing to build it back out if it ended up falling. It's all just based on sentiment and the fact that everybody thinks it's going to keep going up, so they keep buying it. If everyone suddenly decides it's going to go down, it'll become a self-fulfilling prophecy very quickly. But I can't say what'll happen to cryptocurrency. I mean, it's yeah.
That's a really interesting way to look at it, though, in terms of how the US dollar or something like that technically isn't backed by anything like gold or traditional things like that, but it is backed by the assets and the economy of the country. I've never looked at it that way, so that's quite interesting.
It's a little more solid. I guess then you have to assess the assets and the economy of the country, but
yeah. I've seen more, or I've seen at least one country sort of embrace it. I think that was El Salvador, if I'm not mistaken, who are doing some interesting things. But I think they've either bought a lot of it or they've kind of incorporated it into their economic system as a country. So I guess if that becomes more commonplace, then it would have some sort of backing.
Yeah. I mean, I guess ultimately gold is kind of the same thing. It only has value because people have all agreed that it has value and people think it's going to go up. So they're willing to pay a little bit more for it when they buy it. And the next guy is willing to pay a little bit more again, and it goes up. But even gold actually does have, industrial uses and we make jewelry out of it, and it has some kind of intrinsic value, even aside from the investment value. And then I guess there's an argument that gold has had value for, thousands of years. So it has more history than any of the cryptocurrencies do. So I don't know. I can see it is a huge challenge for the regulators and what they do with that and whether they, allow retail investors to buy it or not. But I mean, I think a retail investor can buy it now. And, ultimately, do we want the regulators telling us what we can and can't do? I don't know, that's another.
Yeah. There's a whole nother conversation there about, the sort of, it doesn't have to be governmental overreach, but you hear a lot of questions about that now, with these regulations and that kind of thing.
Yeah.
Gianna, any closing questions or comments before we finish off?
Nothing else from me, John, but would you like to tell whoever's watching how they can contact you?
Oh, yeah. My website is waypointcfo.com. Email address is jstrangway@waypointcfo.com. And yeah, I'm open to having people reach out and have a chat, a conversation, and see if there's something I can do to help them, or just have a discussion.
Awesome. Well, thanks a lot for joining us, John. Some great chat, I think, and some great knowledge and insights for anyone watching as well. So thanks a lot for joining us. To the viewers and the listeners and the audience, thanks for tuning in, and we will see you in the next one.
All right. Thank you very much for having me.